If you wanted to sell because of Iran, those people have already sold.
What's an unemployment rate that would freak the market out?
And this is not in my interest to say this, but the economic data are not particularly useful for calling recession.
As a human, I have to buy food and energy on a daily
Right.
basis. So I don't care how volatile it is. I still have to pay for it.
Sure.
So please talk about it in inflation because it's hitting me. I don't care if it's not hitting the
Right.
Fed's model. Hi there, I'm Liz Thomas, Head of Investment Strategy at SoFi, and this is the important part. If you're an investor, you're probably wondering what to make of this moment. Consumer sentiment is down, geopolitical risk is up, but the economy seems to be holding up. So what are we supposed to do with all of this information? Do we need to just ride it out? Or does this mean that the bull market is finally forming some cracks? If you ask Neil Dutta, he's more in the latter camp. Neil is here with me today, and he is the head of economic research at Renaissance Macro Research, also known as RenMac. He advises institutional investors on the biggest forces shaping markets. I'm so excited to have you here.
Thanks for having me, Liz.
It's like one of the same sitting across the table.
Right.
And I get to ask you questions that I usually get asked. This is so great.
Yeah, I'm
Are
looking
you
forward
as
to it.
excited as I am?
Definitely. It's an exciting time.
Before we get into it, I have to do the compliance thing. Nothing in this episode should be treated as a recommendation from SoFi, and this is not investment advice. Let's talk about just recent market action. It's been a long year already, and the market, honestly, I'm surprised it hasn't gotten more bruised. Certain places have gotten bruised, but I'm surprised that it hasn't gotten more bruised. So what do you make of basically what's going on right now in markets?
Oh, it's a tough one. I mean, I think, there's a few things I would say. I think number one, the markets aren't really pricing in much tail risk anymore.
Yeah.
So we've priced a lot of that out, and I think the markets are very much focusing on the sort of benign base case kind of scenario around what's going on with the war. So I think that's most of it. And there's also just a insatiable appetite, I think, for risk assets. And I think investors over the last number of years have been very trained to kind of buy the dip. If the markets are down 5 to 10%, you should step in. People have gotten tired of kind of betting on a recession that's never actually materialized. So I think that's part of it as well. But primarily, I think what's going on is that the markets have priced out tail risk, and that's what this is about.
And you're talking about left tail risk, the bad
For
risk.
sure. Yeah. I mean, the markets are back to a place where we're not really pricing in a downside risk scenario. So if you look at, something like the blue chip consensus, I would say most economists are probably pricing maybe a 25 to 30% chance of recession, and the markets are basically at zero. I mean, the curve is steep enough, and
It's not inverted.
Yeah, and
Yeah.
and equities are obviously quite buoyant. So, I think that the markets are pricing in a very, very kind of low probability of recession. And I think, in my career, my general sense is that equities have a bias to go up in the absence of bad news. And so, really, the only time you should sell if you're a longer term investor is basically if you have a strong conviction around recession. And I don't think we're there yet, really. I mean, but again, it's really just about pricing out the risk of a bad outcome. And I think that's primarily why the stock market's gone up vertically over the last couple of weeks.
Okay, it's funny that you mention economists changing their recession probabilities, or at least having a recession probability in somewhere the 25 to 30% range, because some of them did change the probability, but it was like, okay, we were at 20, now we're at 25, right? Or we were at 25, now we're at 35. It's still less than 50. And it doesn't seem to be anybody's base case, even the ones that are the most concerned about this. So, and to your point, the only time you should really sell stocks is if you have high conviction in a recession. Then you said we're not there yet. What's the yet part? Could the war cause a recession, or do you just mean yet in the business cycle?
I mean, I think yet in the business cycle.
Okay.
I mean, the war causing a recession, I mean, it's the standard boilerplate that you've heard every person say on the street, which is the longer it goes on,
Right.
the worse it'll be.
Right.
I don't think I've seen in my career, Liz, a group of analysts so convinced about something that hasn't yet happened. I mean, how many times have you seen people talking about, well, the paper markets are so disconnected from the physical markets.
Mhm.
The physical reality is a lot worse.
Mhm.
What's the statute of limitations on that argument? Because that's kind of where I'm at, and I respect them. They all have lots of interesting insight into what supply chains are happening, what's going on with the sort of dated Brent, like all these interesting buzzwords around the energy
Yeah.
markets that we've kind of learned
Backwardation.
yeah. And I don't know. I mean, it just feels like a lot of them are all saying the same thing, and you're trying to get me to believe that the like traders are not pricing in those outcomes. Like, you don't think that they know that there's shortages
That there's
going
a
on?
war going on?
Yeah, that
Yeah.
there's I mean, so arguably, I think what it suggests is that maybe the markets are telling you that maybe the supply chain issues will sort themselves out sooner than you think. But I just think the broader point here is that if you wanted to sell because of Iran, those people have already sold, like in stocks.
Mhm.
So you need to come up with something else to sell. And so for me, that's probably more maybe about this thinking about the second order effects of this. Like, what does it mean for consumer spending that gasoline prices are above $4 and they're going to probably stay there for a couple of weeks? Like, what does that mean for consumers? How much savings buffers do they have to deal with that? What does it mean for the earnings of discretionary firms? I mean, so I think those second order effects are kind of what I'm thinking about more,
Yep.
as opposed to like trading the latest news headline out of Iran, or even like, frankly, like the Strait of Hormuz. And so my thing is, at some point, the rubber's going to have to meet the road. And I think if you don't see basically crude prices surge, this is going to be something that people are going to be like focusing on and studying for years, because as I said, like that to me is like the most interesting thing. I'm not an oil expert, but the oil experts that I respect, they're all kind of saying the same thing, but what their predicted outcome is, it's not really happening yet.
Yeah.
So,
But it will happen if it lasts too long, right?
well, sure,
That's
but
sort of the
yeah, I
stance.
don't. I mean, spot oil should also be higher than what they're saying
Sure.
than what it is, based on all the things they're saying.
Sure.
Like the December 2026 Brent price should be higher than what they're saying it is, right? I mean, again, it's not really reflected in the markets.
Right. So, okay, so here's my take, and then you can respond to it. The market itself, first of all, important to remember, it seems like we have forgotten because we've been so obsessed with the war and energy, which is a very small weight in the S&P. Important to remember that at least 30% of the S&P is technology, right? And then you add some of the other names that are in other sectors, you're up to like 50%. If you've got the Mag 7
Hmm.
plus the technology sector, 50% of the S&P. The technology sector alone is still expected to be the biggest generator of earnings growth for 2026. And this war hasn't really affected the tech sector. It's affected investor sentiment, and there was a pullback, but there's been this huge V-shaped recovery in tech stocks, and particularly even in semiconductors, right? There have been really big bounces in the tech-driven areas of the market. The war, I think, has been enough to disrupt the trends that were in place before the war. So pre-war, the market was sort of churning. It was sort of
Hmm.
sideways-ish, and the story was about rotation. It's about the fact that old economy sectors are really driving the bus. Industrials had done well, financials had done well. We're looking at materials, really like all of this, and materials has done really well. But this rotationary trade and the equal weight outperforming the market cap weight, I think some of those trends probably got disrupted by this war, and investors will flock back to that large cap tech space because now it's at a more attractive valuation, maybe not the most attractive, but more attractive than it was before. So, for the market to continue rising for the rest of the year, do I think it's possible? We have to hold almost two conflicting opinions. Yes, I think the market can keep rising, and I think that things can stay optimistic. But I also think that the war is bad for certain sectors. It's just that those sectors are such a smaller percentage of the market compared to tech that it's not to say it won't matter. It will matter to certain companies, but I don't think it's going to matter to the overall investor sentiment.
It's a fair analysis. I guess the way I'm thinking about it is, for the US, right? I mean, what's interesting about what's happening now is that even though we've had this oil shock, I mean, nat gas prices are very, very low.
Mhm.
And that's really what powers a lot of the AI eco space. And so that, to your point, is probably what keeps that going. Now, I think the risk is that Korea and Taiwan are two very large energy importers, and they're kind of the tip of the spear of the AI trade. I mean, that's really where the semiconductors and a lot of the components come from. And
Mhm.
so, to me, I'm curious to see how that resolves. I mean, obviously the Kospi got creamed and then now it's coming back. So you have three economies. You have the consumer, you have housing, and you have AI, right?
Mm.
And so those three things are kind of going in different directions, I think. The consumer is sort of, I would say, mid, I mean, maybe a little weaker so far this year, probably getting a little weaker going forward because of what's happening with gas. The housing market's in recession. I think that's
Mhm.
very obvious. I think you could make the argument that because this AI growth has been so spectacular, that's putting upward pressure on interest rates, and that's kind of keeping the housing market from having a meaningful recovery. And then you have the AI story, which is this sort of spectacular growth boom, driving up equipment spending and software spending, and parts of non-residential like data center construction. So that's kind of where we are. I think if you're an equity investor, if you look at like PE ratios, they've come in a lot. And so it's an attractive valuation to get back in, right? So
Yeah.
you basically I mean, broadly speaking, the stock market more or less is where it was in February before the war started, around 7,000, and it's but PE ratios have come in quite a bit. And
Mhm.
so if you're a value investor, I mean, that makes sense.
Sure.
You know.
Sure. Well, and all the complaining and hand-wringing we did about valuations being high before, you can't do that as much anymore. Let's talk about the consumer side of it, and but more specifically, and this is something I say all the time, the consumer will keep spending as long as the consumer is employed.
Mhm.
And there are a lot of conflicting data points and headlines about labor right now. So I want to get your read on the labor market. We get some data, things like annual benchmark revisions that showed, 800,000 some jobs
Right.
less than what we thought last year, which actually brought job growth to zero. And then we get a February jobs added number that's severely negative, and then a March number that's more positive. But the unemployment rate is still just at 4.3%, which is
Right.
historically low.
Mhm.
But everybody's out there complaining about there being not a lot of jobs available. Where are we on this labor market thing? Because it feels like we're on a teeter-totter, and it's exactly balanced and, like, nobody move. If everybody just stays exactly where they are, we're gonna be okay, but as soon as one person shifts their weight, we're gonna have a problem.
I mean, to me, I think the surest sign of a tight job market is accelerating wage growth. And right now you don't have that. So um, that's kind of where I am at. I mean, I think it's welcome that unemployment isn't rising rapidly. I mean, we've been very fortunate over the last number of years that the increase in the unemployment rate has been very, very linear in nature. And the unemployment rate has kind of stabilized over the last year, which is also welcome, even though jobs growth has been very, very sluggish for reasons that you've heard about, right? Whether that's immigration enforcement, weaker labor force growth, what have you. But I would just say a lot of folks are kind of saying, okay, because there's no labor force growth, it's essentially like a stealth tightening of the jobs market. If that were true, then shouldn't people be more willing to quit their jobs because they have less competition, right? Like if the president is going around and kicking out potential workers, shouldn't the people that work in those industries be more inclined to quit their jobs
Mm,
because they feel more confident that they can get another one? The balance of power in that situation should be tipping more toward the employee. But
mm,
that doesn't seem to be the case. It seems like businesses have the power in the labor market, not the worker. And so that's one of the reasons why wage growth has generally been slowing down over the last year. Um, and that's been the case even though the unemployment rate is flat. So I think, what we should focus on is what's going on with wage growth. Because if wage growth is accelerating, then the labor markets are tightening. If the wage growth is slowing, then there's slack in the job market. Um, so that's kind of where I'm at. I do think that for the Fed, of course, it's really just about, what is the unemployment rate?
mhm.
But I don't know that that tells you the entire story. And I would just say that even though the unemployment rate has been flat for a while, that hasn't kept wage growth from slowing.
Yeah. Okay, what's an unemployment rate that would freak the market out? We're at 4.3. There are mental thresholds,
So
but
I'm
what's
gonna I'm gonna tell you a little secret, right? So I this is not in my interest to say this, but
okay?
um, the economic data are not particularly useful for like calling recession,
Mhm,
right? That's what you want to look for is something that Greenspan talked about, which was discontinuities in the data. So I don't know that there's necessarily a magic number in my head about what the unemployment rate should be. But if I see the unemployment rate not moving for several months, then all of a sudden for a couple of months you get zero point 0.1, 0.2, then that would worry me, right? But the data itself, you know, it's not like you can't just look at the data and say, like, "Oh, we're going into recession." Like you have to
mhm.
look for these discontinuities in the numbers, and it's really hard to see it right now because look at the payroll number. I mean, the sign has been flipping on that number for the last year, more or less. I mean,
Mhm.
positive than a negative. So I would just say that what would worry me would probably be rate of increase because that's ultimately what the Fed cares about, right? I mean, if you think about back to 2024 when they went 50 basis points in September. Why did they do that? They did that because the unemployment rate was rising a lot more rapidly at the time. If you see the unemployment rate going up a tenth to two tenths of a percent every month for a few months, then I think that would probably concern them.
Yeah, I've always uh, basically subscribe to the idea that the Fed watches things on 3-month moving averages, 3
Hmm.
or 6-month moving averages. So if they don't call it a trend until it's been happening for 3 months. And then you've got things like the SOM rule where it's I don't even remember exactly what it is. It's like if the unemployment rate hits a certain
Half a
level
percent above its
above its
12-month low.
12-month, right. Okay. So there are some benchmarks, but even those have triggered and not caused a recession. So now I think people are in this place where it's like, does the business cycle even really still matter? I'm very much of respect the cycle, right? We
Yeah.
will go through the phases of the cycle. So all the talk that happened about, well, after COVID, things changed and then AI came in and it made us just skip recession entirely. We went back to early cycle. We started over at early cycle and then mid cycle and whatever. I don't believe that. I believe that it's very difficult to know exactly where you are in the cycle when you're in it, but I don't believe that we skip parts of the cycle. And things have probably gotten more elongated because of AI, and maybe the later part of the cycle has gotten more elongated because of AI and the companies that are involved in it. But we don't just like unsubscribe from recessions.
I mean, I would just say that if you think about cyclical areas of the economy, usually, I think recessions happen when there's excesses in the real economy that translate into excesses in the financial markets.
Yes.
And, um, where are the excesses in the real economy right now? I mean, probably, frankly, in like tech equipment. I mean, that's
Mm.
probably where it is. I mean, now, of course, it could go on for a while.
You mean just like all the equipment that we have?
Yeah.
Like the fact that
Yeah.
we've got
Information
iPads and
processing.
phones and earbuds and
Well, no, that's like durable goods spending. But
okay,
I'm talking more about like information processing, like the business side of it.
got it. Okay.
Um, Software spending. I mean, that sort of thing. I mean, they're contributing quite a bit to GDP growth. Really, we haven't seen it since the 90s. Now, that could continue for a while.
Mhm.
But to me, that's probably one area of excess. You could say maybe parts of durable goods consumption could be a little bit stretched. I don't think you really have much excess in housing. I mean, housing kind of had a strong recovery right after COVID. It's kind of normalized. It's sort of bouncing along the bottom right now.
Mhm. It's at more or less a stalemate. I mean, there's
It depends where you look. I mean, I think with respect to housing, I mean, obviously the resale market can't get any worse than it is right now.
yeah,
So that's, I guess, a good thing. I mean, it's really hard to see existing home sales getting any lower. On the other hand, home builder sentiment is really, really weak. And builders have been allowing their margins to compress substantially just to get
right.
sales going. And they've been doing all these affordability adjustments.
Yeah.
And I think there's a limit to how long that can keep going. And at some point, I mean, they're going to have to decide we can't make things work. And that's probably going to mean they're going to lower their guidance around starts, and probably that should bleed into employment as well, residential construction employment. That's kind of what I expect. So
Mhm.
that's something to think about. I mean, builders did go into the year with the most completed unsold units for sale since 2010. So there's really not much reason for home builders to make homes,
Yep.
and there's not much demand in the pipeline for new homes right now. So I would say that's why I say housing is in recession. And, I mean, that would be a catalyst for weaker growth. Whether that's enough to get you a recession, I'm a bit skeptical of that. But certainly that's a catalyst for weaker growth going forward.
So it's an interesting topic to bring up because something that I cover often about the labor market is that construction employment leads the broader labor market
Sure.
by I don't know, it varies, but let's call it somewhere between 6 and 12 months,
Hmm.
okay? So when you see construction unemployment roll over, you should expect that the broader labor market probably sees a rollover shortly thereafter. And we haven't really seen that. There's been sort of a plateau, but my question being, what if it's offset by construction of data centers and construction, all of the stuff that's happening because of AI? So then construction unemployment as a whole doesn't really fall. Then you've got these sectors that are having completely different
Sure.
experiences.
Well, I think the issue with that is kind of like the issue with energy, right? Which is in energy's case, consumers lose the money faster than producers can use the money.
Hmm,
And in this case, to your point, residential construction employment will probably go down before non-residential construction can perk up, right? Because in many
yeah.
cases, the people, where are they building the data centers? It's not necessarily in the places that are seeing the weakest growth in housing, right? Like particularly new construction, right? So, in Florida, for example, I mean, are they building a lot of data centers in Florida? No. So that's really a lot of where the weakness
Yeah.
is
Yeah.
in these sort of southeastern markets. So I think it's probably that recycling process probably takes longer, and so I think it's probably more of a headwind in the short run than sort of a automatic offset from non-res. And keep in mind that non-residential investment, like structures investment, which is what economists call it in the GDP accounts. I mean, that's basically been contracting for several quarters now. I mean, so even though we've had this strong growth in data center construction, you haven't really seen total non-residential structures pick up. So even though we've seen growth in data centers, there's been weakness in other areas like shopping malls and lodging, and we're not making as many hospitals as we used to. And
People still expecting to build shopping malls? Is that really a thing still?
well, if we have more households being formed, then you need more commercial enterprises to service those households.
Huh. I thought malls were like a thing of the past,
You should come.
a thing of
You should
childhood.
come visit us in New Jersey.
Yeah, there that's true. I don't spend a lot of time in New Jersey. Okay, let's talk about the Fed. Let me start with, do you have a rate prediction for the rest of the year? Do you feel strongly in one way or another about cuts or hikes or no movement at all?
I think the odds favor cuts. I never really bought into the idea that the Fed was going to be hiking because of an oil shock.
Hmm,
So I've generally been leaning against that. Like, I mean, there's plenty of people that follow macro that kind of are getting towards that point. Like, oh, if there's going to be a quick resolution, the next move will be a hike. Like, I'm not there. I tend to think that there's also been not as much undoing of the inflation progress that we've seen. So when I look at things like trim mean inflation, right?
what's that?
Trim mean inflation is basically so the traditional core is when you take out food and energy, right?
Mhm.
It's sort of an artifact of the 70s. But when you look at trim mean, that's basically doing is stripping away the most volatile components, both on the high side and on the low side. And when you look at that, it shows ongoing improvement in underlying inflation. So, and it's very like neutral, right? I mean, it's just what are the most volatile components? It doesn't care, it's not saying it's food or energy. It's just it is what it is,
Mhm.
right? So when you look at it that way, I mean, it shows ongoing improvement for trim mean inflation, and I think that that's helpful because there's a wide body of research to show that when you look at inflation like trim mean, it tends to be a better forecasting measure of actual inflation than core inflation. So,
Okay.
um, in other words, I think to me the inflation process is really about housing and labor, and to a lesser extent, energy. And when I look at housing and labor, I'm getting relatively good vibes from that, right? I mean, the rents are slowing in most of the country. And then, as we just discussed, labor costs are still cooling, like wages are slowing. So that should over time bleed into non housing services, which is what the Fed cares about. Um, so, yeah, that's why I favor cuts.
Okay. I have a hard time with all these inflation measures that just strip out the stuff that's a problem, right? We've got core is one thing. We
Hmm.
take out food and energy. I have a hard time with that because as a human, I have to buy food and energy on a daily
Right.
basis. So I don't care how volatile it is. I still have to pay for it.
Sure.
So please talk about it in inflation because it's hitting me. I don't care if it's not hitting the
Right.
Fed's model, right?
Yeah. Yeah.
And then we came up with this super core, which was core services
Yeah.
X shelter.
Hmm.
Okay, so now we've taken out energy, we've taken out food, we've taken out shelter, and we're just going to measure the stuff that's left. But again, as a human, I have to pay for all three of those things,
Sure.
right? So we're just going to take shelter out because it's bothering me. Right?
Yeah. I
It's
mean,
not good for the metric. So let's just remove it. And then I trim mean maybe is just another version of all of that. So it's like I
well, I
struggle
guess
so
the
much with
benefit
it
of it is
because
that it's
the average
unbiased, right?
person
Yeah. No, I get it. I mean, I think
deals with it.
yeah, I mean, I think well, right. I mean, for sure. I think these things have human costs, and so it's. I remember so vividly. Back in 2008, I was a junior analyst at Merrill Lynch, and I used to work for David Rosenberg,
Hmm.
who's a legend on Wall Street,
Mhm.
and
He skews bearish.
he does, but be that as it may, I think what was funny about it was he had made the point where he was sort of like doing the X this, X that, X that. When he's
Uh-huh.
like strip all these things out, like
Uh-huh.
there's inflation zero. And I remember, I think it was Harley Bassman, also someone who's very well known. He's like he gets on the hoot on the Squawk Box, and he's like,
Uh-huh.
"I'm sorry, David Rosenberg, you can't X everything out of inflation and tell me inflation is zero."
Well, sure you
Um,
can. You take it all out, it is 0.
yeah, because ultimately, you have to look at this sort of as dispassionately as possible as a business economist, right? Like,
Sure.
there are always people behind the statistics, but what our job is to basically to formulate an economic opinion and then help people make money with that economic view. And so the reason we're doing that is because we're trying to forecast where actual inflation is going. As I said, there's a wide body of research to say when you do strip some of these things out, you can do a better job forecasting headline inflation than just focusing on headline inflation, which is why the
Hmm.
Fed looks at it. My own sense is personally, I would much rather them just focus on something like wage growth, like nominal income growth. If it's slowing, that probably means that you should be at least having an easing bias. If it's rising, then you should have a hawkish bias. But, you know, in the defense of the economists that do the stripping out of all these different measures, that would be the
Yeah.
argument that I'd give you.
Okay. I think there are probably a lot of consumers who are not economists who would say, take your measures and shove them, right? Okay, so back to the Fed a little bit. If the Fed faces a situation where in their dual mandate, right, of maintaining full employment and stable prices, if those two mandates are absolutely conflicting. So let's say the war in Iran does actually drive inflation higher, headline inflation, not core,
Hmm.
obviously. So let's say inflation goes higher because companies have passed things through and it's up to a troubling level. Let's call it at least 3.5, maybe it's up to 4% again. But you've got a labor market that's cooling and you've got an unemployment rate that's approaching 5. Their jobs are not being added, initial claims, whatever. Like both things are definitively happening, right? I'm not going to sit here and say this is what stagflation is. But with Warsh in the seat, the Fed as it is right now for the voters for 2026, if those two things are conflicting, which one do they choose?
I think it's if unemployment is rising as rapidly as you just laid out, they're cutting.
Okay.
Like I think
Okay.
that's not even. I don't
I
think
agree.
it
I
wouldn't be
totally
a.
agree.
I don't think it'd be a close call because ultimately it's really difficult to get concerned about like a broad-based inflation if the labor markets are falling out of bed. It just
Yes.
means that consumers don't have the wherewithal to absorb the higher prices. I mean, you're already seeing that, right? I mean, consumers are very price sensitive,
Mhm.
right? If you look at goods consumption, right? I mean, the areas that are going up the fastest in price are actually the areas that people are cutting back the most, at least over the last number of months. So I think consumers are price sensitive, which would be
Mhm.
consistent with the idea that they're not really seeing rapid growth in wages. So to me, if you have an energy shock, it just means they have less left over to spend elsewhere. And that means they ultimately have to cut back in different places, which will ultimately drive down the prices for those goods and services where they're cutting back. Um, one interesting wrinkle in all the inflation stuff is that, pass through from oil is actually shown to be quite low.
Mm.
Obviously, pass through from tariffs is higher, but we know that we're kind of lapping the tariff shock, right? I
Right.
mean, in some cases, maybe the tariff rate is coming down a little bit. So I think it's going to be interesting to see how that push and pull plays out with core inflation going forward, because you'll see this fading of the tariff effects, and I think that
Mhm.
probably overwhelms whatever pass through you might get from oil.
It sort of neutralizes it.
Yeah, well, more than offsets it, sure.
Yeah,
Yeah,
yeah. Well, and there's been a school of thought too that already what we've seen for the first part of this year as an oil shock has been neutralized by higher tax refunds, stimulus that's gone out, right? And that when that all fades, if the war de-escalates around the same time, it does sort of just end up, yes, as a fringe risk, and yes, probably some pressure, but not something that's as lasting and dramatic as everybody suggested.
yeah, which goes back to the point we were talking about earlier. It's all about
Right.
how long it lasts, right?
Right. Yes. It's all about how long it lasts. Okay. A question about just basically the cycle in general. It's always been my school of thought, and I say this a lot. I preach it on TV and wherever I can, is that it usually all happens in a sequence. The market goes first, earnings go second, the economy goes third. You talked about economic data being a poor predictor of a recession. You can't really look at that and decide whether or not there's a recession. And then for everybody who's not familiar with an organization called the NBER, they declare recessions, but it doesn't happen until, I don't know, 6 months after the recession's actually begun. And
Right.
we're well aware we're in one. And then they tell us that we're in one. And it's like, oh, thanks. Thanks for the
That's the
news
time to
flash.
buy.
Right. Exactly. Because it's later and
Hmm.
economic data is always lagged. But my question is more about the first two steps of that. So market goes first, earnings go second. If we're looking at a market that has basically looked through this war for the most part,
Yeah.
there's also an argument to be made that the market is right a lot of times.
Right.
So if the market is going up right now, is it safe to assume that earnings will be as healthy as expected, or maybe even stronger than expected?
Yeah, I mean, so generally speaking, I definitely think that price leads data. um, but I would just say that equity markets are not a perfect discounting mechanism,
Right.
right? I mean, so if they were, they wouldn't have peaked in the spring of 2010, and they wouldn't have peaked in October 2007, and
Sure.
so I think they're much better off the lows than at highs, to be
Okay.
honest. So
What do you mean by that? They're much better at bouncing off the low and being
yeah, I mean, I
durable?
think when the markets have put in a low and are rallying, then you that's probably a better sign that we have a sustainable turn in the earnings cycle
Okay.
than the alternative, which is when, when the markets are already at highs and they're starting to go down. Does that necessarily mean that we're about to go into a recession? Like, I think that not always, right?
Right.
So if you're a US focused investor, you obviously have to be invested in equities. I would just say that if I had to say one bearish thing about the stock market, it's right now. It's basically that I don't think the stock market's pricing in left tail risk
Mhm.
anymore. We were
Mhm.
kind of there for a month, and now we're not.
Yeah.
And
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 I
I and
think
I
that's
think there
fair.
are yeah, and I think there are risks. I mean, like, so for me, and I think what's important for what I do and the clients that I have is that it's about your thought process. Like, you're never going to always be right. Like, no one's always right in this business. But what you want to have is like a sort of thoughtful way of thinking about the world. And if that's helpful for your investment process, that's really what you're trying to do here. So for me, back in 2022, I had this view like we wouldn't have a recession, right? Like I said, there was going to be no recession. I think the street was like very much on the other side of that call. And I got my flowers for that.
Mhm.
But for me, the process hasn't changed since then. Like, it was about income growth, housing, government spending, and just the way people were thinking about the world, right? Like, so back then everyone was bearish. So it's almost like technical analysis, right? If everyone's bearish and then things are still, there's no recession. If everyone thought there was going to be a recession and then there wasn't one,
Mhm.
then that requires companies to have to invest more, and you need to spend more on your inventories, and you need to hire more people to kind of catch up to where demand is now.
And the stock market was undervalued.
Yes,
That's what
exactly.
it
And so
tells
as
you
the
that
market was pricing out
right.
recession risk, the stock market was rallying
Yeah.
in into 2023 and 24.
Yeah.
Um, but if you play those same four factors now, like, is real income up or down? It's going down.
Mm.
Is the housing market, I mean, back then, the Fed was hiking very aggressively, and by the end of 2022, home building stocks were actually doing okay, and builder sentiment was actually doing okay, and builders still had like a huge backlog of homes they needed to finish, and so there
Mhm.
was a lot of activity still going on in housing despite all those hikes. Now, I mean, the Fed has cut 175 basis points over a couple of years. The housing market's arguably worse now than it was
Mhm.
a couple of years ago. Government spending, like state and local governments were flush with cash back then. Now they're cutting back.
Mm.
Um, and everyone's bullish, right? I mean, if you go back to the
Mm.
beginning of the year, there was a lot of enthusiasm for the reasons that you mentioned, right? Like tax refunds and deregulation, and we're past the tariff war. He's not going to do anything crazy in the midterms,
Mhm.
like all those sorts of arguments. So, um, that to me is like, so if you play those same factors now, it leaves me more cautious than everyone else. So, but that's, at least it's an open book. Like that's how I'm
Yeah.
thinking about it.
Well, kudos to you for being bullish in 22. I certainly was not. And then I was too cautious through 23 for a lot of the same reasons that started to spook me in 2022, but that's when the AI revolution started and it changed things in 23, right? ChatGPT came out late 2022, and then in 2023 the investments started and some of the big companies started to get involved. I think there was an announcement by Microsoft in January of 23, and then everybody kind of got on board throughout that year, and that was on the heels of tech companies in early 22 having cut a bunch of jobs, and it was like, "Oh my gosh, here's
Yeah.
the recession, here it comes," right? So, some of those traditional metrics of, okay, there's all these jobs being lost in technology in
Right.
2022, and that feeling of this is how it starts, this is how it begins, but that never showed up in the data. That never showed up in the unemployment rate, it never showed up in jobless claims. It just, like, vanished.
But also remember, at that time, we had a lot more inertia within our labor market than we did. So people were able to, I mean, if you lost your job, you were able to find a job relatively
Yeah,
quickly back then because the labor markets were much, much stronger. I mean, if you had a wave of tech layoffs on par with what you had back in 2022, I don't think the labor market right now could handle it, to be honest.
yeah.
So we have much more like sort of sclerosis in our labor market now than we did
Huh.
3 or 4 years ago. So, um, but I also think the reason why everyone was betting on recession is because, and I kind of bought into it too for like a few months, which it was like the Fed was telling you that they wanted one.
Right,
And so if, everyone's always like, don't fight the Fed.
right.
So the Fed was saying, we think a recession is required to quell the inflation issue. And
Right.
then as
Some
yeah,
pain may
yeah,
be
and that's what the
necessary.
markets were doing,
Yeah,
and so but ultimately, as time went on, it was clear that we didn't need to take as much pain in order for
yeah,
that to happen,
yeah.
and so, that's but I mean, there's a lot of model fitting that goes on the street, right? Like, if the Fed's models, for example, like, if you have inflation well above target, I mean, the models are going to assume some kind of, like, period of below trend growth to
Yeah,
kinda bring inflation back to target, and I think a lot of economists at the time were just sort of going by that.
yeah. Well, I certainly was one of them, and I remember a big part of my thesis at the time was that not necessarily that the Fed was asking for a recession, but that they would have been okay with it if it happened, and that they weren't gonna try to get us out of it because they thought that it would solve the inflation problem. So then the Fed backstop sort of disappeared in my
Right.
mind, but I think what I got wrong during that period was underestimating the strength of the actual capital market, that maybe we didn't need the Fed to backstop it. Maybe we didn't need the Fed to protect us from recession. And that was a period, I mean, inflation hit its high in June of 2022 at 9.1%. That's the highest inflation I had seen in my career. And
Mhm.
it was like, okay, so now we've got the highest inflation that I've ever seen in my career, and we've got tech layoffs. This is the biggest sector in the S&P, and all the companies are laying people off. I felt like we had two of the main ingredients for a recession to form, and then it sort of did. right? There were 2 consecutive quarters of negative growth. They were very small, but then it got revised away, and it just never really materialized. So, the lessons that I think people learned from that period, self included, we have to carry forward, and that was the period that started to teach me, okay, the business cycle is not as clean as what I wanted it to be, right? It's not as clear cut as like, okay, we're early cycle, now we're mid cycle, now we're late cycle,
Right.
we will recess, right? Like
Yeah,
I
yeah.
wanted it to be a lot cleaner than that. But when you have a technology revolution that comes in and changes the game, it's not
Yeah.
as clean.
Yeah, I mean, I think the other thing is that relation I mean, there's a lot of, like, indicator macro that goes on, right? Like, "Oh, the ISM is below 50." Like,
Right.
never before
Yes.
has the
Yeah.
economy not been in a
Right.
recession. I mean,
The
uh,
leading indicators have been predicting recession for like 3 years.
but I would just say that the fundamental like, to me, the flaw with, like, indicator macro is that it basically is sort of you're assuming that relationships are stable from one cycle to the next, and they rarely are, right? Like,
Hmm.
so Um, that's why I say it's about your thought process. Like if you that's the best leading indicator, right? Like if you're right about how you're thinking about the world, the data ultimately should reflect that.
Hmm. Yeah. Okay. So having said all that, how would you tell people to position right now?
I'm not a strategist, I'm an economist. Yeah, I mean, I think I have, look, I mean, I'm more cautious on the economic outlook. That would probably mean that I should be positioned more defensively, right?
What
Like
does that mean to you, though? Are we talking like cash and treasuries defensively or
I
like
mean, I like
consumer
duration.
staples?
I like duration.
Okay.
Um
So long-term treasuries kind
Yeah,
of
I mean,
duration?
I think 10-year yields are attractive here for
Yeah.
sure. I mean, nominal income growth is slowing, and the 10-year yield is at 4.3%. So I think 10s are a buy here. And so that probably means that I also like bond surrogates in the equity market, like the bonds in drag, right? Like telecos and
Okay.
maybe utility stocks.
Utility, even though utilities has been wrapped up in the AI trade.
Yeah, okay. So maybe what about like water utilities or
Okay.
like
Okay.
So I mean, consumer staples, it's hard to know what to make of that. I mean, obviously, like a lot of them are going to be pressured because of the inflation story and what that means for consumer spending and so forth. But yeah, I mean, I would probably favor them over discretionary stocks.
Yeah. Well, they do tend to do well in midterm election years, and so does healthcare. So if you're looking to be defensive in the equity market, especially in a midterm election year, typically it's staples and healthcare. I would say you got to be a little careful in healthcare right now because it's a hot button issue, obviously, for the administration. But I think we're pretty distracted from the healthcare
Right.
stuff with a war and tariffs and everything else. So there's an argument to be made that healthcare kind of gets through midterms unscathed, and that there's a little shift back into defensive sectors later in summer, early fall. That would be my take.
Okay.
Okay. Well, thank you, Neil,
Thanks for
for
having me.
balancing out our take on the economy. Um, I had a very healthy debate with my analyst this morning about all of the same stuff. And I'm leaning more on the bullish, constructive side, and he's probably a little more in your camp. So nobody is
That's what
making any
makes a
bets,
market.
but exactly,
Hmm.
that's what makes a market. Yep.
Hmm.
Well, thank you for joining us.
Thanks for having me.
All right. Well, that was a masterclass in economic analysis. A couple nuggets that I took away. First of all, he's leaning more cautious, leaning a little bit more defensive on the economy and concerned perhaps more than the consensus is saying right now. But what was really interesting about the way he laid things out is that he said there are three types of the economy. There's the consumer, there's housing, and there's AI. And all three of them are basically moving in different directions right now. So that's what's made this so difficult to analyze and find a direction for investors. Second nugget that I thought was really interesting, and I'm actually going to do this going forward, is instead of focusing on the unemployment rate, he said, talk about wage growth instead. Focus on wage growth. And if it's accelerating or not accelerating, that's really the tell in the labor market. And if you are going to focus on the unemployment rate, look at the rate of change rather than the level itself. And lastly, I would just say there are shocks all the time. in markets and there are shocks in the economy, not all of those shocks cause Armageddon. Not all of those shocks end up being as bad as we thought they were in the beginning. And frankly, nothing is ever as good as it seems, and nothing is ever as bad as it seems. That's another old market adage to live by. So thank you again for listening, and we look forward to bringing you the next episode very soon. For more from me, read my weekly column in SoFi's newsletter, On the Money, and on the SoFi website, or follow me on X at Liz Thomas Strap. Follow The Important Part wherever you get your podcasts. The Important Part is produced by SoFi in partnership with Sony Podcasts.
Investments are not FDIC insured, are not bank guaranteed, and may lose value. Elizabeth Thomas is a registered representative of SoFi Securities LLC and an investment advisor representative of SoFi Wealth LLC. SoFi Invest is a trade name used by SoFi Wealth LLC and SoFi Securities LLC, offering investment products and services. Robo-investing and advisory services are provided by SoFi Wealth LLC, an SEC-registered investment advisor. Brokerage and self-directed investing products offered through SoFi Securities LLC, member FINRA SIPC. For disclosures on SoFi Invest platforms, visit sofi.com/legal. For a full listing of the fees associated with SoFi Invest, please view our fee schedule.